to Kim and Greg.
Great, thanks very much, Malcolm, and good morning, everybody. Thanks very much for having us here with you all today. Can you hear us or hear me okay? Thumbs up, everyone, nodding heads. Great, thank you. Thanks, Righty, and to the WSBA for having us today. It's good timing to talk about this stuff, even though we scheduled this session a few months ago. There's an article in today's West that details a bit about WA consumer confidence. There's another article that talks about a report commissioned by Creditor Watch that suggests that 94% of businesses would do okay to the end of the year without JobKeeper. I'm interested to get your thoughts on that as we get through our discussion today. And whilst things might be going pretty well over here in the West, every day we're hearing the stories coming out of Victoria. And, you know, we can't help but think what it must be like over there at the moment. We're all pretty lucky. We're getting back to life as usual. But over there, it just must be quite a stark contrast. And from a business perspective and an economic perspective, it'd be pretty daunting over there at the moment. So we want today to be interactive. We'll get a lot of our content out of the way early so that we can open up to discussions. But we do have some slides to share, so just bear with me while I get those up. Right, is it okay if we get screen sharing happening? Thank you. Still showing as disabled. I'll jump on now. Okay, we're good to go. Okay, everybody see that all right? Nod your head if you can. Thanks, everyone. Okay, so first of all, a little bit about us. We are, the firm here, HLB Insolvency, is headed up by myself and Kim. We're supported by 7 wonderful staff, and they help us do what we do. What we do is just insolvency work. So we do all the corporate and personal types of insolvency appointments, which is a little bit rare. We've got an attendee here today, Helen Joyce, and those who weren't here in the beginning, Helen's also a trustee in bankruptcy. So she's a specialist in the personal insolvency area. You know, what we like to think about ourselves is that we're a bit different from your average insolvency practice. Apart from straying away from the standard issue black insolvency suits, you can see I'm wearing navy blue today. Kim's got a nice shade of dark grey on. We're a little bit different, but we do care about people. We like to help people. That's where we derive our motivation from. And what that means is always taking meetings when there's no work in it for us. It means treating people with respect and dignity, often in a time when they're really dealing with some difficult issues. And it means open communication and not really just reaching for options that serve us. It's about looking for options that serve people. So that's what we do. And then we'll move into the topic proper, and it wouldn't be a presentation from a couple of accountants if we didn't have a graph. And what we're here to talk about today is what COVID-19 has done in the insolvency space. And contrary to, you know, popular belief, and even just at the drinks last week with the WSBA, a lot of people said, geez, you guys must be busy in insolvency. The actual fact is that we're not busy. We've actually had quite a downturn in insolvency, and we've got some graphs here. This is straight out of the Australian Securities and Investments Commission. The blue line was last year and the orange line is this year. And you can see that from March, there was a big drop in insolvency appointments. And it's a big disparity from last year. So what we're going to talk about is why is that the case, and what's caused the big change in insolvency. Just throughout this session, please feel free to jump in. Righty, I'm not sure whether people are on mute, but if anyone has a question to ask, we're happy to just field questions as we go along. Happy to talk about any issues that come up as they come to mind.
That's absolutely fine. Greg, I haven't muted anybody, so
okay,
it's totally in everybody's hands. I trust them as grown-ups.
No worries. Thank you, Righty. So we'll talk about some of the temporary changes that came about at the beginning of the pandemic, and some of these you might already know, but I'll just rehash a couple of those key ones that came up very early on in the piece. So the first ones came about quite swiftly in March, and they had to do with altering the way a creditor can pursue a debt. So in the corporate world of insolvency, if you want to get a company into liquidation or make a really formal claim on your debt, the way to do that is by issuing a statutory demand. And the government acted really swiftly to jump in and change a couple of things. They changed the threshold, normally $2,000 up to $20,000, and they increased the period to respond from 21 days to 6 months. And the same thing happened in the personal insolvency world, which is a bankruptcy notice, and that went from 5,000 up to 20,000, and then also out to 6 months. Now, the ATO normally does probably 9 out of 10 court-appointed liquidations, and because of this restriction, they're inactive. I mean, aside from the general authority anyway, which Kim will talk about soon, there's not a lot of statutory demands being issued at the moment because we're not going to wait.
And then get me to sign on the way back. Yeah. Thanks, man.
Hello, are you there? Someone's in there having a chat about signing some documents. You know who that is, Radi?
It's okay, they're not only
Yes,
That's
ma'am.
all right. Yeah.
I can't see if I am finished. If whoever has just joined, could you mute yourself, please? Thank you.
Thanks, Radi. So those are the changes around the demand processes. And then there are also some changes brought in to try and protect directors. So it's all got to do with insolvent trading. So these are directors of companies, and ordinarily it's a big no-no to trade whilst insolvent. It's a breach of duties under the Corporations Act, and it's something that us as liquidators look really closely at. But during this time, with all the uncertainty and you know, what the government tried to do was give people a bit of breathing space, give people the opportunity to be entrepreneurial without being reckless, and to try and find a way to get through all of the uncertainty that was on the table. So the idea was to, you know, allow businesses to carry on even if they might be a bit shaky. There won't be any relief from this director's duty if there's been reckless conduct or egregious conduct. And both of these things to do with stat demands, bankruptcy notices and insolvent trading started on the 25th of March, go for 6 months. And so you would have heard people talk a lot about this tidal wave being in September and in October. This is what it's all got to do with. So I'll hand over to Kim now. He's going to talk a bit about some ATO observations.
And just before that, yeah, Greg mentioned about the temporary relief measures, and we've all heard the word zombie company, or most of it has, and I actually Googled to see, I thought this is a good name that us Australians have picked up, but not quite the case. The origin is it came about in the 1990s, a so-called lost decade in Japan, where they had companies there that were either surviving on bailouts or they could meet their interest on their debt, corporate debt, but could not ever pay back the actual capital. And so that's what a zombie company is, and it makes sense. You know, we just refer to the terminology that, you know, the can's just been kicked down the road, and when things go to change, well, we will address that shortly. But the timing, we don't really know. That insolvent trading side that Greg mentioned, the 6 month relief, unless it's, you know, reckless and dishonest. But if there's been no mention of that at this stage about whether that will be extended, if it is, then it'll change the so-called tsunami or steep slope or cliff that we are all expecting. Now, looking at you can see on the screen now, there's nothing new there you wouldn't be aware of there. What concerns us mostly about these things, you've got all of this, and there are some people, not that many, but have actually, you know, got their PAYG credits brought back. And for those non-accountants, that's the amount that's paid typically on a quarterly basis for your tax for the year, as distinct from your PAYG withholding group tax. So that means that they don't have to pay their PAYG for the March and June quarter, but even to the extent that you can actually get a refund of PAYG that you paid for your September and December quarter. So that means that when these companies lodge their tax returns, they will have zero in the bank as far as the credit bank at the ATO. In theory, they might have a bit in their cash at bank. So they put the tax return in, and then when they have to pay their tax, wow. So there's that side of it. We all know about the rent referrals, and we had a good session a couple of weeks ago with Cullen McLeod. That worked out really well, and there's that 50% reduction that you can have there. Some of the relief is not relief, but it's a sort of a deferral, and that's going to come back to bite people. And similarly, when we talk about the actual individuals, and we all know people that have not making payments to their bank. People have used the word holiday. Again, it's not a holiday, it's just a deferral. So when all these things come back around, there's going to be some people out there that I think Helen, and being the person insolvency side of us as well, we do that as well, as you know, there's going to be a lot happening. So that's sort of a lead into that. Has anyone got any comments about clients or people they know as, you know, getting these referrals and how they think they might be going to address these when the deferral starts having to be repaid back?
Kim, I think there are a lot of people just delaying here, probably a little bit head in the sand. Unfortunately, we don't see many small business in particular, running forecasts, and so I would be suggesting to you that they're actually not fully appreciating the cash flow impact that this will have on their business down the track. And if they're not preparing for it and they're not planning for it, it's going to come as a nasty surprise to them. I think even if in the back of their mind they're thinking, well, there's some tax to pay somewhere down the track. So yeah, it's
Mark, and you probably had almost all have read Greg's name in today's paper because it wasn't there, but we thought it was going to be there. Kate Parnell, is it Parnell?
Yeah, Parnell.
Yeah, she's wrote an article. Anyway, what Greg said to me yesterday, along the lines of what you're saying, Mark, is the head in the sand. But it's all about cash, and it always has been. But you know, the monthly or the quarterly management accounts to know where things are going. A lot of people we've seen, particularly the non-sophisticated ones, how you going? Pretty good. Yeah, got money in the bank still. Bit of a struggle. How you going?